All right, so Suntec REIT just dropped their full-year results for 2025, and honestly, the numbers tell a really fascinating story. It's all about strength here at home versus some struggles overseas, so today we're going to break down exactly what this means if you're an investor.
Okay, let's just jump right in with the big headline number you need to know, 14.6%. That is a huge year-over-year jump in what's called distributable income, basically the money that's available to be paid out to investors. And while that's a fantastic number on its own, the story behind it is what's really interesting.
Now, just in case you're new to this, let's do a super quick refresher. A REIT, that's a real estate investment trust, is pretty much a way for you to invest in a whole portfolio of big properties, like shopping malls and office towers, without having to actually buy the buildings yourself. You just buy units, kind of like stocks, and you get a cut of the rental income. Simple as that.
So, the key thing to understand about that big 14.6% number is this major contrast. It's really a classic tale of two portfolios. The properties here in Singapore did incredibly well. I mean, so well that they basically managed to cover for the weaker performance of their properties overseas. It's a real balancing act.
So, you're probably asking, where did all this growth come from? Well, the engine room for Suntec REIT this past year was, without a doubt, right here at home in Singapore.
And right at the heart of that success is the iconic Suntec City. We're talking higher foot traffic, more rental income from both the office towers and the retail mall. All of that was a massive contributor to the REIT's really strong performance.
And get this, just look at how full these properties are. The Singapore office portfolio is sitting at a 98.2% occupancy rate, but the retail side, a staggering 99.5%. I mean, these are prime assets running at pretty much full capacity. That's a fantastic sign of a really healthy, in-demand portfolio.
And it wasn't just Suntec City pulling all the weight. Nope. Other top-tier assets like the ones over at the Marina Bay Financial Center also put in a really strong performance, and that was mostly because they were able to command higher rents.
So when you boil it all down, Singapore's success really came down to a pretty simple formula. More tenants paying more rent, combined with smarter spending on operations and interest. And to top it all off, the convention business is actually expecting an even stronger 2026. So good things on the horizon there.
But, that's only half the picture. Let's switch gears and talk about the international portfolio, because that's where Suntec ran into some pretty serious headwinds, especially in Australia and the UK. Yeah, you can see here that occupancy rates in both Australia and the UK actually slipped a bit compared to last year. Now, it's not a huge dramatic drop or anything, but it definitely points to some softness in those markets.
To be fair, the overseas story wasn't all bad. Some properties, like 177 Pacific Highway in Sydney, actually held up pretty well. But then you had others, like the Minster Building in London, that had some major vacancy problems, and that really dragged down the overall numbers.
And hey, to their credit, the company was really upfront about these problems. This quote right here from their own press release specifically calls out those underperforming properties. It shows they're not hiding from it, they know where the weak spots are, and they're being transparent about it. Okay, so with this kind of mixed picture in mind, what's the outlook for the year ahead? Let's break down the opportunities and the risks that investors really need to be keeping an eye on.
For any investor looking at this, the outlook is really a balancing act between opportunities and risks. On the plus side, you've got the Singapore office market, which looks super resilient. But on the risk side, there are definitely some worries about retail spending and, of course, that ongoing vacancy issue at the Minster Building we just talked about.
And this, right here, is the central question for anyone watching Suntec REIT. I mean, the entire investment case for the next year or so really hinges on the answer to this one thing. Can that powerhouse Singapore portfolio keep being strong enough to carry the whole team?
So, look, all of this is really interesting, but what does it actually mean for your wallet as an investor? Let's get to the bottom line, the actual payout. Okay, the single most important number for any REIT investor is something called the DPU, or distribution per unit. Just think of it like a dividend. It's the cold hard cash you get for every single unit you own in the trust.
And here's the payoff. Even with that mixed performance and the weakness overseas, the incredible strength of the Singapore portfolio was enough to boost the final DPU by a very healthy 13.6%. We're talking a jump from about 6.2 cents to over 7 cents per unit. That's what investors really care about.
So as we wrap this up, it all comes back to that one critical question. The REIT absolutely delivered for investors this past year, all thanks to its hometown heroes. The big question for 2026 is, can they do it again?
And finally, a quick and important disclaimer. This content is intended to serve strictly and only as an informational, independent, objective summary of recent events, and should in no way be interpreted, construed, or relied upon by any party as inside information or financial advice.